Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden within company reports. Today we're diving deep into C3ai's latest financial filing, and let's just say it looks like their past, present, and future are looking interesting. If you love getting the real story behind the numbers and understanding what these disclosures actually mean for a company's direction, make sure you are subscribed, and if you want to chat about this filing or any others with fellow finance enthusiasts, join our Discord community. It's linked right below in the description. C3ai, an enterprise artificial intelligence software company, has just dropped its quarterly report, and it paints a clear picture of a business navigating some significant shifts. We've got declining revenues and rising expenses, and the company is making some big strategic moves. Let's break down what this all means. First up, the balance sheet. As of the 31st of October 2025, C3ai has about $103 million in cash and cash equivalents, plus another $571 million in marketable securities. That is a pretty healthy chunk of change. However, their property and equipment, goodwill, and other assets are relatively small compared to their overall size. This tells us they are not holding a lot of physical assets, which is common for software companies, but it does mean their value is heavily tied to their software and intellectual property. Looking at their liabilities, total current liabilities stand at around $130 million, which seems manageable given their cash on hand. But when we look at total liabilities, it is about $189 million. This is where we need to pay close attention. Now, for the big one, the accumulated deficit as of the 31st of October 2025, it is a staggering $1.6 billion. This means C3ai has lost more money than it has made since it started. This isn't uncommon for growth-focused tech companies, but it highlights that profitability is still a long way off. Moving on to the income statement, also known as the statement of operations. This is where we see how the company is performing financially. Their total revenue for the 3 months ending the 31st of October 2025 was about $75 million. Now, this number might sound good, but it is a significant drop from the $94 million they brought in during the same period in the previous year. That is a nearly 20% decrease in revenue. For the 6 months ending the 31st of October 2025, revenue also saw a similar fall, dropping from $181 million last year to $145 million this year. That is a 20% decline again. This is a major red flag. Digging deeper, their subscription revenue, which is usually the most stable and predictable part of a software company's income, also took a hit. It fell by 13% for the quarter and 16% for the 6 months. This suggests that either new customers are not signing up as much, or existing customers are spending less. Given that subscription revenue makes up about 90% of their total income, a drop here really hurts. Their professional services revenue also saw a sharp decline, dropping 63% for the quarter and 45% for the 6 months. This often means fewer customers are needing extra help building or implementing the software, which could be a sign that customers are struggling with adoption or that C3ai is reducing its focus on these services to cut costs. With revenues down and costs going up, their gross profit has taken a serious hit. For the quarter, it dropped from $57 million to around $30 million. That is a nearly 47% decrease. Their gross margin, which is the percentage of revenue left after accounting for the direct costs of providing their service, has shrunk from 61% to 40%. This means for every dollar they earn, they're keeping much less than before. Now, despite the revenue drop, their operating expenses have actually increased. Sales and marketing went up by 5% for the quarter and 12% for the 6 months. Research and development also increased by 5% for the quarter and 13% for the 6 months. General and administrative expenses saw the biggest jump, up 19% for the quarter and 20% for the 6 months. When you combine lower revenues with higher expenses, you get a much bigger operating loss. For the quarter, their operating loss ballooned from $75 million to over $112 million. That is a 49% increase in their operating loss. For the 6 months, the operating loss widened from $147 million to $236 million, an increase of over 60%. This is clearly a company focusing on growth, possibly at the expense of short-term profitability, but the current trend is concerning. On a brighter note, their interest income from their substantial holdings in good quality investments like US Treasury securities and corporate debt decreased slightly due to lower interest rates, but remains a decent source of revenue, bringing in about $7.5 million for the quarter. All of this leads to a net loss. For the 3 months ended the 31st of October 2025, their net loss was over $104 million, up from about $66 million the year before. That is a 58% increase in their net loss. For the 6 months, the net loss is around $221 million compared to about $128 million last year. That is a nearly 70% increase in their net loss. This translates to a net loss per S-Hair of 75 cents for the quarter compared to 52 cents last year. For the 6 months, it is $1.62 per S-Hair, up from $1.02. This means that for each share of C3, AI stock you own, the company lost more money this period than in the last. Looking at the statement of stockholders' equity, we see the changes in the company's net assets. The class of common stock value has increased slightly. Additional paid in capital also saw a healthy increase, largely from stock-based compensation and the issuance of new shares, which is how companies often incentive employees. However, their accumulated deficit continues to grow, as we saw in the income statement. So, while new investments are coming in, they are not yet enough to overcome the losses. Now let's examine the cash flow statement. This is crucial for understanding the company's actual cash generation and usage. The company used $80 million in operating activities during the 6 months ending the 31st of October 2025, a significant increase from the $30 million used in the same period last year. This mainly comes from their net loss. In their investing activities, they purchased over $331 million in marketable securities, but also sold and matured over $343 million in securities. This means they are actively managing their investment portfolio. However, the significant cash burn from operations is a concern for liquidity, even with their substantial cash reserves. Financing activities provided over $7.9 million, primarily from stock option exercises and employee stock purchase plans. This means employees are buying into the company, which can be a positive sign, but it is a small amount compared to their operational cash burn. Diving into the notes, we find more detail. Under the notes on revenue, C3ai breaks down its income by geography. North America still dominates, accounting for 95% of revenue in the latest quarter. Europe, the Middle East, and Africa represent a much smaller portion. The company is carrying almost $233 million in remaining performance obligations. This is basically money they are contracted to earn in the future, which is good, but it is down slightly from last year. They expect about $136 million of this to be recognized as revenue in the next 12 months. While this provides some visibility into future revenue, the overall declining trend in revenue raises questions about whether they will meet these obligations. A significant point here is customer concentration. A limited number of customers are still accounting for a substantial portion of their revenue. For example, one customer represented 13% of revenue in the quarter. This means that if any of these key customers decide to leave or reduce their spending, it could have a major impact on C3ai's financial health. They also have a large amount of unbilled receivables, over $62 million, which means work has been done and revenue is earned, but it has not yet been billed or received. There are several significant legal matters disclosed. The company is facing a securities class action lawsuit, with an amended complaint filed including allegations about misstatements concerning a partnership and their sales force. Then there are 6 shareholder derivative actions alleging breach of fiduciary duty, among other things. Most recently, a new securities class action lawsuit was filed in August 2025 concerning statements about the CEO's health and its impact on business operations, along with 3 related shareholder derivative actions. While the company states they do not believe it is probable that these cases will result in an unfavorable outcome. Significant legal battles are expensive and can distract management. There is also a lawsuit against Enel for billions of dollars related to trade secrets and breach of contract. These legal entanglements are a huge risk factor and could lead to very costly settlements or judgments. The financial footnotes also reveal a significant amount of stock-based compensation. For the 6 months ended the 31st of October 2025, they recorded over $133 million in stock-based compensation expense. This is a substantial amount, reflecting their reliance on equity to attract and retain talent. While it is typical for tech companies, it does dilute existing shareholders and adds to their overall expenses. The risk factors section is extensive and frankly a bit scary. One of the biggest risks is precisely what we're seeing in the financials. They have a history of losses and anticipate operating expenses will continue to increase, meaning profitability is not guaranteed. They explicitly state they may not be able to achieve or maintain profitability in the future. This is followed by the risk that a limited number of customers still account for a substantial portion of their revenue. If these big customers leave, it could severely impact their results. They also highlight intense competition and the risk of losing market share. This is a major concern given their declining revenue. They face competition from internal IT departments, other software providers, open source options, and even their own cloud partners. Many competitors have significant advantages like larger budgets and established customer bases. Another critical point is the long and unpredictable sales cycles, especially for their large subscriptions. This means they can spend a lot of time and money trying to land a deal, with no guarantee of success. This makes it hard to forecast revenue and manage cash flow. Then there is a significant leadership change mentioned. As of the 1st of September, a new CEO, Stephen Ahikian, took over. While Mr. Siebel, the founder, remains as executive chairman, this transition and past health issues of Mr. Siebel are highlighted as potential disruptions to their sales strategy and overall business execution. Such transitions can create uncertainty and affect performance. The company is classified as a large accelerated filer, meaning it is a significant player with a public float of over $700 million. However, its market cap as of the 24th of November 2025, with over 137 million shares of Class A common stock outstanding and 3.5 million shares of Class B, is significantly lower than that, indicating its stock may be trading below its potential. They admit to a restructuring of their sales and services organization in the recent quarter, which has been disruptive. This, combined with leadership changes, is cited as a reason for their poor financial performance. This restructuring also comes with the risk that their new sales and services teams may not become productive quickly enough. Now, looking at C3ai's latest report, it is clear they are in a challenging phase. The declining revenue, widening losses, and increased operating expenses are significant headwinds. Their reliance on a few large customers and the intense competition in the AI space are major risks. The leadership transition and the restructuring of their sales force add another layer of uncertainty. While they have a substantial cash reserve and some solid investments, the rapid increase in operating losses and the continued accumulation of deficit suggest they are burning through cash at an accelerating rate. The legal proceedings are also a major overhang that could drain resources and negatively impact their reputation. So, what is the verdict for C3ai? They're pushing hard in the AI space, especially with generative AI and agentic platforms, which are undeniably areas of future growth. However, the current financial reality shows they are struggling to translate this innovation into profitable revenue. It's a high-stakes game of growth versus sustainability. Right now, the numbers suggest a company that is investing heavily for future potential, but with very real current financial pain. Investors need to watch closely if their strategic pivots and renewed focus on sales productivity can reverse the concerning revenue and loss trends. Without a clear path to profitability and with major legal risks looming, it is a risky bet. Alright, that is our breakdown of C3ai's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.